Exxon Mobil Corp, ticker symbol XOM, is currently at $111 a share and is at about its all-time highs. This stock has been on an absolute tear since the pandemic. I've been saying to buy this back in February. I've done 3 videos on this saying buy, buy, buy. It's gone from $32 up almost 250% to $111 a share. So is this the right time to continue investing in Exxon? Well, that is the question I'm going to answer today. What we're going to be doing is looking at my stock valuation spreadsheet, looking at the financials, taking it to my discounted free cash flow model and my Ben Graham valuation model to see if this stock is a buy or a sell. Just quickly getting into some of the news. This is one of the highlights I saw the other day. One of the headlines is Exxon declares its 91 cents dividend and announces a 35 billion share repurchasing plan. The company has also increased and extended share repurchase program with up to 35 billion of cumulative shares repurchased in 2023-2024. It's kept its dividend steady against Chevron by increasing it to $1.51 a share. So as I said, this is the stock over the last 5 years, up 50%. Now, if we compare this to the S&P 500 over a similar time period, you will see that Exxon is currently beating the market by about 7% over 5 years. If we take this over a much shorter line, the S&P 500 is down 4%, where Exxon is up 27%. This has been a fantastic period for these energy companies, and let's see if this can continue. So let's go to my stock summary spreadsheet. Exxon has a market cap of around about $450 billion, a very, very nice 3.2% dividend yield, and an ex-dividend date of the 9th of June. So let's go through my steps. First, we look at the PE ratio. Is it less than the market? And Exxon has a very low PE ratio of 8.4. Next, we want to see if the revenue is increasing. This is the money generated from normal business operations, and it is up massively, 255 billion to just shy of 400. Now, if we look at these numbers increasing, 255 down in the pandemic, up to 267 and then 400. So Exxon's revenue is increasing year over year quite dramatically. Next, we want to look at the net income, which is basically the revenue minus everything else, all the costs of the goods, and it is up massively once again. Now, it's gone from 14.3 to 55.7. That is a massive, massive increase. And we can see here in the pandemic year, they were down negative 22 billion. Had a strong bounce back year, and then even more so again. They've managed to generate a lot more profit based on the revenue. You can see the revenue has less than doubled, but they've more than doubled their profit. So they're able to generate a lot more profit from their revenue, which is excellent. Please give a like on the video. As I said, let's try and get this one to 15 likes. That'd be really cool if we did. Anyway, let's get back onto it, as you don't want to hear me talking about likes. Shares outstanding decreasing. No, this is a fail. As you can see, they have been issuing more shares very, very slowly. But as we have seen, they are going to do a repurchase program over the next couple of years. But if we do look at the share price over those last 5 years, they have been issuing more shares. And then that was actually quite good because the stock went down, and they've continued to issue more shares as the stock price has gone up. So they're actually buying the stock at sort of a peak, which normally would be a negative, but they're only buying the stock back because they think it is undervalued, which at $111 a share, I'm quite surprised about, but they've been on an absolute roller coaster these last 2 years. Then we want to look at the free cash flow. Is the free cash flow increasing? And that is cash from operating activities minus capital expenditures. And surprisingly, yes, it is up massively. 5.3 to 58 billion. Now, what can they do with this? They can, well, the more free cash flow a company has, they can pay more dividends, they can pay down debt, they can buy back shares, as we're seeing, and they can grow the company. Now, it's hard for these companies to grow, but then again, over the last year, with the energy crisis that's gone on, you can see how they've been able to generate a lot more revenue and profit. 5.3 minus 2.6, 36 billion, and then 58. So that is a massive free cash flow generator at the minute. That's 4 passes and a free cash flow ratio of 7.78. So I am thinking discounted free cash flow model is going to really like this stock. So what we've done is we've calculated the future free cash flows based on averages, discount them to today's value, and then we get a stock price based on that. and the calculated stock price is $40 a share. Now that seems low to me, but if we look at the numbers here, because these are based on averages, you can see that the next current years are 11 billion and increasing to 12 billion in 2026. They currently have about 60 billion in free cash flow, so I do think we need to tweak these numbers a little bit. On the revenue, analysts are expecting increasing revenue, so I think the revenue numbers are fine. The net income margins have been about, what, a 10% average, so we'll increase that one to 11%. Now you can see the free cash flow numbers. The free cash flow estimates have jumped up massively, and this puts the stock about fairly valued if they're generating about 33 billion. But as we've seen here, they're generating a lot more. So let's bring this up to the previous free cash flow to net income margin, 104%. That puts the stock at $150 a share. Still, they have not. This doesn't include increasing cash flow from 2022. Let's just tweak the numbers a little bit more to see what that would look like. 130, 140%, that would bring it up to 61. Then it will put the stock at a $200 stock, making it just shy of a $1 trillion company. Seems a bit high, but you can see these numbers are well within what they've been doing over 2022. Now we want to go to the Graham's valuation model. What this does is it takes the earnings per share, the PE of a non-growth company, the expected growth, and then the AAA bond yield over the corporate bond yield. And we can see here from looking at the Yahoo analysts what they give the company as a growth rate, and they're saying over the next 5 years around about 27%. Past 5 years was 22, so they're expecting it to be more growing than it was over the last 5 years, which is good to see. And I have already looked at this number. I'm pretty surprised by it. The Graham valuation gives it a stock value of around about $778 a share and a Graham price of $584, meaning this is trading at a massive discount according to Ben Graham's model. This does seem a bit high to me, but it shows you how much this likes the stock. This is with a 26% growth rate. To get the stock fairly valued, we have to take this down to even about a 2% growth rate over the next 5 years for this stock to be fairly valued. Let's just say they can only grow at 5%. That's quite a conservative number. You can see still this stock is around about a $200 stock as per the model. So both of the models are in love with this stock, which is surprising. But I've been a fan of this stock. Once it got to the bottom in the pandemic, I was buying it all the way up. Unfortunately had to sell due to some reasons here. I'd made double my money, thought it was fantastic, and the stock has gone on an absolute tear. So as per the models, it still looks like it is a buy. Right guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already, and I will catch you guys next time.